This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
When a business starts to trade, there are, as we have seen, many taxes that may impact in terms of the running and operation of that business. There is, for example, an original decision to be made. When a business is set up, should it be set up as an unincorporated trade, for example, a sole trader or a partnership, or should it be set up as an incorporated trade, i.e. a company? That will impact seriously on how individuals and other entities will be assessed. If, for example, you go down the unincorporated route, then you must remember back to the early chapters. Chapter 4, what did we see there? That for the business profit and loss account prepared for the unincorporated trade, we need to adjust up that profit and loss account. Part of that adjustment of profits is dealing with the add back of depreciation and the substitution instead of capital allowances. Chapter 5, as I recall. We then look at the bases of assessment. How do we relate an accounting period that the sole trader or partnership have chosen to prepare their account to any date in the year they choose? How do we relate that then to the tax year in which it is assessed? What are our bases of assessment? But what we know is once we have a tax-adjusted trading profit for the accounting period, then it is that profit that the individual is assessed on. The individual is charged to income tax on their adjusted trading profits. But if the business had been set up as a company, what then? Well, if it was incorporated, then, though the rules of adjustment of profits and capital allowances are slightly different, the basic rules are the same. But now for the company, we must prepare a tax-adjusted trading profit and move on, if necessary, to compute the taxable total profits. Those profits will then be charged to corporation tax, so we need to be familiar with corporate tax there. But the owner-managers of the company, they, of course, will then only be taxed on the money that they take out of the company. Well, how can individual owner-managers take money out of the company that they have set up and are now trading through? Well, in their position as owner-manager, as a manager, they will pay themselves a salary. How do we deal with salaries? Well, we know that, of course, is employment income to feature on the income tax computation of the individual. We also know that so far as the company is concerned, when it pays wages, salaries to employees, whether that is the owner-manager or any other employee, salaries and wages are deductible expenses so far as the company is concerned. And on that basis, therefore, that will reduce the company's taxable total profit. The other way by which the owner-manager can take money out of his or her business, as an owner, pay themselves a dividend. Well, dividends, of course, are not tax deductible for the company. Dividends are distributions out of the taxable profit. They're distributions, they're not expenses, so they don't achieve a corporate tax deduction. But then in the hands of the individuals, they are taxable income. Whether we pay any tax and how much tax we do pay will then depend upon the individual recipient. Are they merely a basic rate taxpayer, or are they now up into higher rate, or even indeed up into additional rate, to work out how much, if any, additional tax charge will apply? So we can set the business up as unincorporated, profits chargeable to income tax on the individual, incorporated, profits chargeable to corporate tax on the company, and the individual owner-manager is then charged to income tax on the money they take out of the company, be it a salary, be it a dividend. But in relation to the profits of the unincorporated trader, in relation to the salary paid to the owner-manager, there's another tax. National insurance contributions, of course, are relevant here as well. So there's a whole range of taxes that impact on the ongoing business. When you dispose of that business, then equally capital gains tax may be relevant there. If, of course, you give the business away, inheritance tax may be relevant as well. A whole range of potential taxes relevant in terms of the lifetime of ownership of the business. And now it is that, having dealt with all those taxes that I've just made mention of, be it income, be it corporate tax, be it capital gains tax, inheritance tax, be it national insurance contributions, but now we turn our attention to value-added tax. And it's a tax that, when an individual starts a new business, the individual may be very concerned about, because they'll have no practical awareness of the operation of how the VAT system works. What, again, now some of you will be familiar with is the term value added tax. If you live within the EU, you'll be very familiar with VAT. Even here in the UK, we'll be familiar with it, well, for another couple of years anyway, before we depart the EU, it would appear. But VAT you'll be familiar with. Those outside the EU, it may be a term that we are unfamiliar with, but you may be familiar with the term sales tax that applies there. Again, often there is a sales tax charged on the sale of goods to either other businesses or eventually to individual consumers. Our version of this is VAT, and that's what we now need to know. Now, it's a tax that is administered by and paid by the business. It is a tax that is ultimately incurred by consumers, as we will see. Right. Now, when a new business starts, probably one of, well, certainly in VAT terms anyway, the very first thing that they'll need to know is whether or not the business needs to register for VAT. And if it does then need to register for VAT, how do we go on to account for VAT? But firstly, the issue of VAT registration. What brings us into the VAT system requiring the business to account for VAT and eventually to submit VAT returns? There are two issues when it comes to VAT registration. There is compulsory registration and, as we'll see a little bit later, there is voluntary registration. The first thing that we have to deal with is when is a business compulsorily required to register for VAT. And here there are two tests that may determine the business's requirement to register for VAT. The first issue that we look at for compulsory registration is, as you see here in your notes on chapter 25, compulsory registration based on historical turnover. We're going to look back, as we'll see, look back over the previous 12 months to see whether that turnover exceeds the VAT registration threshold that would then require that business to register for VAT. Now, we're obviously talking about a business. We'll talk about traders here. Now, whether that trader is unincorporated or incorporated makes no difference. This is a taxation administered by businesses. Whether unincorporated, sole traders, partnerships or incorporated companies makes no difference. All businesses will have to deal with VAT. Well, they'll have to deal with it in terms of administering the system if they register for VAT. So, the rules of compulsory registration, firstly on historical turnover. Now, what we do is to look at the types of supply made by a business. And in VAT terms, the supplies that are made, i.e. sales made by the business, may be said to be either taxable supplies or exempt supplies. And when we look at taxable supplies, you will see here that there are two types of taxable supply relevant, at least in our syllabus. Most supplies are standard rated, which requires the business to charge an extra 20% on what would have been their selling price as the standard rated VAT. So again, very obviously, if here we were about to sell our goods for £100 and we are now VAT registered, then we're going to have to add on 20% and sell the goods for £120 to our customers. Clearly, therefore, making our goods more expensive than they would otherwise have been. And that, of course, may be an important issue in terms of whether a business does voluntarily choose to register for VAT or not. It, of course, may be the case, as with most businesses, that the level of taxable supplies they make is at such a level that it's not a question of whether they want to. As we see here, they will be compulsorily required to register for VAT. So, the business making a supply where the business's sales price would be £100 has to charge 20% VAT on top, therefore giving a VAT inclusive price to be paid by the buyer, by the consumer, of £120. If, on the other hand, it was zero rated, then it is still a taxable supply, but there is no VAT to charge, and therefore the price stays at £100. Now you may consider, why bother to have a zero rate? Now we'll see the relevance of supplies that are zero rated for the business in a few minutes' time, in terms of if we are VAT registered, are required to deal with the sales that we make and charge VAT on taxable supplies at either 20% for standard rated, 0% for zero rated supplies. But only if we are registered for VAT may we then recover the input tax, as is known, the VAT that we've suffered on the goods and services that we as a business have purchased. If they were inclusive of VAT, we, for example, were the buyer here, paying £120 to the seller, inclusive of 20% VAT on the vendor's sales price, can we as a business recover the £20 worth of VAT that we suffered? And what we'll discover is that if we make taxable supplies, though we are required to account for, as we call it on our supplies, output VAT, we account for output VAT on the sales that we make. These are the outputs, the sales from our business. On the inputs, on the purchases and expenses, we can then recover the VAT that we've suffered on those purchase costs, on the goods and services supplied by other VAT registered businesses to our businesses. Now that is as compared to if we as a business make exempt supplies. Now if we make exempt supplies, clearly they are not taxable. There is no VAT to charge. But although there is no VAT, the same as would have been the case, we remember, if we made zero rated taxable supplies, this has a very, very different and important impact. For if we make exempt supplies, then we cannot recover the input VAT that we've suffered on the purchases of the goods and services. That makes our costs 20% bigger on such purchases and expenses than they would otherwise have been, which we'll see with examples in a moment. So, taxable supplies are, as we have just said, those that are either standard rated or zero rated. The trader is then able to register for VAT and must then account for the output VAT on the sales. As long as you make taxable supplies, then you are able, if you choose, to register for VAT. Again, we'll see in a moment the level of activity that would require us to compulsorily register for VAT. But if we are registered for VAT and we do make taxable supplies, then although we have to account for the output VAT on the sales, when we sell for £100 plus 20%, i.e. £20 VAT, we do not get to keep all of that £120. The 20% sales tax, the VAT, belongs to Hmrc, and we have to account for that on VAT returns, normally, as we'll see later in these notes, on a quarterly basis. We have to pay over that VAT to Hmrc, but we only have to pay over the excess of the output VAT over the input VAT that we have suffered on purchases and expenses, whether those purchases are either capital or revenue expenditure in nature. But if we are making taxable supplies, we can reclaim that input VAT. So we'll only end up paying over to Hmrc the amount by which output VAT exceeds input VAT. Now we'll do examples of that in a moment, but again, just to finish off the things that we've said about the different types of supply, if a trader only makes exempt supplies, then that trader is unable to register for VAT and cannot therefore reclaim the input VAT, cannot reclaim the input VAT. Right, let's have a little look at an example just to understand the workings therefore in terms of the VAT system. Right, here we go, a little example I've prepared for you. If you want to make a note of that, and I'll talk you through it. We're told that a trader purchases goods at a cost of £60,000 including VAT. So we are buying goods from other VAT registered traders at a price of £60,000 inclusive of VAT. So there is input tax that the business has suffered on the purchases of those goods. The trader also incurs expenses. So we've got purchases that we've suffered input VAT on. We've got expenses that we've incurred that also we suffer VAT on. Here the expenses £12,000 including VAT. So the suppliers of goods have invoiced us at costs of £60,000 and the suppliers of those services have invoiced us for expenses incurred of £12,000, all of which are of course inclusive of VAT. Our business has then got on to sell those goods for £100,000 at the moment exclusive of any VAT charge. So let's have a little look at how we would deal with this. First of all, let's assume that the business makes taxable supplies. Now those taxable supplies could either be standard rated, so we charge 20% on the sales of £100,000, or zero rated, in which case there'd be nothing to charge on the sales of £100,000. But so long as the sales that we make are taxable supplies and we are registered for VAT, then we can recover the input VAT on the purchases and expenses. So how much input VAT would that be? Now on the purchases, the VAT inclusive figure is 60,000. Now be very careful here. That is 60,000 inclusive of VAT. Remember what inclusive of VAT means. It means that on top of the seller's normal price, they have charged plus 20% of that selling price VAT, an extra 20% VAT. So it means that the price that we've paid to those vendors of £60,000 is their price plus 20% VAT. So it's 120% of what their otherwise sales price would have been. So if we're going to calculate a VAT inclusive figure, how do we calculate the VAT on that figure of £60,000? We do not take 20%. 20% was the figure charged on the VAT exclusive figure. This is now 120% of that figure, and we want 21/20ths of that figure. So on a VAT inclusive figure, we take 21/20ths. At its lowest common denominator, for ease of calculation there, you may realise that that is 1/6, but it is 21/20ths. Now put that through your calculator and you will discover, again, even without maybe through the calculator, 1/6 of 60,000 is £10,000. That is the amount of input VAT that we've suffered. The person who sold those goods to us would have had a sales price of 50,000 plus 20% VAT. Well, 20% on 50,000 would be £10,000. There is your £60,000 cost that we incurred. The vendor selling those goods to us, their price was 50,000 plus 20% VAT is another 10,000. So we had to pay our cost inclusive of VAT was 60,000. How much VAT is there in that 60,000? It is £10,000 that you see there. So if you need to calculate a figure of VAT, which you may very well have to do in answer to an examination question, the first thing you've got to do is to look at the given figure and read as to whether that figure is inclusive or exclusive of VAT. Because if you were told that the purchase was 50,000 exclusive of VAT, then you'd have to work out 20% VAT on the VAT exclusive price. that was 10,000. If, as is far more likely on a purchase, you're told the cost you actually incurred, which of course is inclusive of VAT, then you take 21/20ths of that VAT inclusive figure. And so we get input VAT of £10,000 that we've suffered. And then on the expenses, well, you should be able to work that figure out for yourself now as regards on that £12,000 inclusive of VAT, how much VAT have we suffered? So again, it's a VAT inclusive figure. You'll find that the numbers are of course very friendly here. Times 20 over 120, 21/20ths, 1/6 of 12,000 is £2,000. So we have suffered two lots of input VAT. Our input VAT that we have suffered for this particular period on the purchases and expenses that we have incurred amounts to £12,000. Now then, we will be able to claim that back off Hmrc, where it is, as it is here, in relation to taxable supplies. So let's look at the VAT that we then have to charge on our sales. Now let's assume to begin with that our sales are standard rated. Now, if our sales are standard rated, remember the figure of sales, £100,000 exclusive of any VAT. So standard rated sale, £100,000 plus 20% VAT equals of course £120,000. So we would have issued sales invoices to our customers for the goods that we have sold to them amounting to £120,000, which included £20,000 of VAT. £20,000 of VAT. Now again, if that is the case, then we have output VAT on those sales equal to, now you can see what the figure is here, 100,000 exclusive plus 20% was 20,000, 20,000 VAT. The other way of looking at it, of course, was if you got a VAT inclusive figure, 120,000 times 20 over 120 equals, of course, again £20,000. So look at what we've got. Our output VAT that we've charged on the sales that we have made to our customers. Remember, that money is not our money, it belongs to Hmrc, it is tax, it is value added tax. But against that, we can offset our input VAT that we have suffered on the goods that we have purchased and expenses that we have incurred that were chargeable to VAT anyway, £12,000 of input VAT. So on a VAT return, normally produced, as we'll see later, on a quarterly basis, we account for the excess of our output VAT over the input VAT. So we would have to pay Her Majesty's Revenue and Customs that difference between the output VAT on the sales and the input VAT on the purchases and expenses. So on this particular period, for this particular business, the business would have to pay out £8,000 of VAT, that excess of output VAT over input VAT. But that was where we had the most likely type of supply that was taxable, standard rated. Think what would have happened if it was zero rated. If it was zero rated, then very obviously in terms of output tax, it would be zero. There would be no output VAT. So then on our VAT return, think what we would have if we were now dealing with zero rated supplies. Our input VAT would still be exactly the same. We have suffered £12,000 of input VAT. Our sales in terms of our output VAT on sales would be nil. So this time we have suffered more input VAT than there is output VAT. This time, therefore, we could reclaim from Hmrc £12,000. Instead of us paying them, they will pay us. We can reclaim from Hmrc the £12,000 worth of input VAT that we have suffered. So look at the two types of supply, taxable supply that we may make, and we can see the impact in relation then to the amount, if any, of VAT that we pay over to Hmrc. If we make taxable supplies, what is a constant is our ability to recover that input VAT. We will get back that input VAT if we make taxable supplies. We then got to see whether on the sales that we make as a business we have to account and charge for VAT. If we do, then we had output VAT here of 20,000. We charged more VAT on our sales than we suffered on our purchases and expenses. We owe to Hmrc, it's not our money, it's their money, £8,000. Whereas, if we have merely suffered VAT on purchases, but we have not charged any on our sales, then we have no money to pay over to Hmrc, and they will give us back the VAT that we've suffered. So the constant is the ability to recover input VAT so long as we make taxable supplies. If, on the other hand, we had made exempt supplies, then, although in terms of input tax we will still have suffered the £12,000 worth of VAT on our purchases and expenses, the input tax that we can recover will be nil. Our input tax recovered will be nil, because we can only recover VAT on our costs in relation to the taxable supplies, the sales that we make as a business. Any input tax on purchases and goods, purchases of goods acquired, expenses incurred on services performed for the business, the ability to recover that input tax is based on the type of supply we make. Make taxable supplies either zero or standard rated, you get back the input VAT. But if you make exempt supplies, then although you do not charge, of course, any output tax, that will be nil, you are unable to recover any of the input tax. Therefore, that input tax of 12,000 on your purchases, on your expenses, becomes a part of the cost base of the business. That therefore increases your costs by 20%. Now, what would be interesting here is for us to work out what, from an accounting point of view, would go through your profit and loss account in relation to these purchases, expenses and sales, based on whether the business was making taxable supplies or whether it was making exempt supplies. So you have a think about that for one moment, if you would, about how you'd now calculate the profit made by the business. Now remember, through the profit and loss account, as you should know anyway from your accounting studies, we will put there the figures of sales exclusive of VAT. Any VAT charged does not belong to us. It's then a question of what go in as your costs. If you're able to recover input VAT, so you make taxable supplies, then it's the net, the VAT exclusive figures that go through your profit and loss account. If you cannot recover input VAT because you make exempt supplies, then you incur the full cost, so it's the VAT inclusive figure. Look what will happen to the profits of the business based on the numbers that I provided to you there, please. So the calculation of the profit, therefore, now if the business makes taxable supplies, whether those are standard rated or zero rated, the sales figure, so far as the business is concerned, is £100,000. That is the price that would be charged by the trader. The only question is whether or not VAT had to be added. But the sales figure is the VAT exclusive figure, 100,000. The purchases. Again, if we make taxable supplies, we can recover the input tax in relation to those purchases and expenses incurred. So it's the net cost that goes through our statement of profit or loss. So our net cost of purchases is 50 and expenses is 10. So the total costs incurred, £60,000, the profit is £40,000. Let's compare that with if the business were to make exempt supplies. Now, again, just like with zero rated, there would be no VAT to charge. So if the business makes exempt supplies, the sales is still £100,000. Now again, that's going to be the same figure of sales, irrespective of whether or not we make taxable supplies or exempt supplies, and if they're taxable supplies, irrespective of whether they are standard or zero rated. So the sales figure 100,000. But if we make exempt supplies but have incurred costs inclusive of VAT, because we only make exempt supplies, we cannot register for VAT, and on that basis we cannot recover input tax. So our business will incur the full VAT inclusive costs. We will not be able to get back the input tax suffered on our purchases and expenses. So the VAT inclusive figures are, again, as we've written above, 60,000, 12,000, total 72. So our profit figures now only £28,000. So we can see the impact, therefore, of whether or not the business makes taxable or exempt supplies. Now, we've said here that if we make taxable supplies, then we have a right to register for VAT. If we do not make any taxable supplies, then you cannot register for VAT, and the consequential effects as we've seen in terms of your base costs. But if you do make taxable supplies, then as we've said, you may choose to register. We'll look at the basis of voluntary registration in just a short while. But the first issue that your client, your new business client, may be concerned with is when do they have to register? So what about compulsory registration? Right, let's have a little look then back at the note. Let's go back to those notes here where we had our introduction to compulsory registration. So what we've done so far is to make the statement about the types of sale and the types of input, so the outputs and inputs that a business may have, looking at the different types of those outputs and the effect on the recoverability or otherwise of input tax. So when is it that the business must register for and therefore account for VAT? Here we go in section B. A trader making taxable supplies must register for VAT if, now here's the rule that we need to learn. Now this is referred to as the historical turnover rule, so we're looking back in time. And we look back over the previous 12 months. And if during the previous 12 months to the last month end, the value of taxable supplies, so either standard or zero rated, exceed £82,000. This is when we'll be required to register for VAT. We'll discover that if we only make zero rated sales, then we don't have to register for VAT if we do not wish to, but more of that later. But otherwise, taxable supplies exceeding £82,000, that's when we are required to register for VAT. However, VAT registration would not be required if the taxable supplies in the following 12 months, if they will not exceed £80,000. These figures are always exclusive of VAT. Now, if we do get to the stage where, when we get to a month end, going back no more than 12 months, it's on a 12-month cumulative basis, but we get to the end of a month, and within the previous 12 we have now exceeded the VAT registration threshold of £82,000, then we are required to register for VAT. When must we register? Hmrc must be notified within 30 days after the end of the period when the taxable supplies exceeded £82,000. The trader will then be registered from the end of the month following the month in which the limit was exceeded, or from an earlier agreed date. So let's just have a little example testing out these particular rules. Let us say, for example, that we exceeded the £82,000 level of taxable supplies that we exceeded that £82,000 at, say, the 30th of April of 2016. So going back over the preceding 12 months, we come forward month by month, and this is the first time that we've now exceeded there the VAT registration limit of £82,000. Okay, what is then the rule? We must notify Hmrc within 30 days after the end of that period. So 30 days on, in terms of exceeding that VAT registration threshold at the 30th of April 16, will be the 30th of May 16. So we've got 30 days in which to register. We will then be registered with effect from, and therefore have to account for VAT on the sales, but get to recover VAT on our purchases and expenses. We have to account for VAT. Again, there, trader will be registered from the end of the month following the month in which the limit was exceeded. Well, the end of the month following the month in which we exceeded the limit was the 31st of May. So it's after that, so that therefore means from the 1st of June 16. So the end of the month following the month in which the limit was exceeded, we exceeded the limit 30th of April 16, the next month May, 31st of May 16, the end of that month, so we'll then be registered with effect from the start of the following month, the 1st of June. So we're registered with effect from the 1st of June. So any sales made from that point in time, we're going to have to account for output VAT. But of course, when we account for output VAT, then we can recover input VAT as well. Now, the type of question that you get here in an exam is as per example 1, where we're told here, Orchid Limited. Now, whether it was Mr. or Mrs. Orchid or Orchid Limited, if it is a business, that is what concerns us as regards the requirement to register for VAT. So this business commenced trading on the 1st of June 15 and had sales as follows. Right. What will you now do? Get your calculator out and start adding through. Now, go through for 12 months. So we started in June, so that would go to the end of May. So I'll need you to get your calculators out. Now, if before you got to the end of May, you hit a month where the total cumulatively exceeded £82,000, then it is at that point that now the above rule would kick in. You'd have to register within 30 days and register then from the end of the following month, i.e. from the 1st of the next month, here 1st of June 16 in our example. Now when you add through those numbers, I need you to do it now, but you won't yet get to 82,000. And that's the usual situation for an exam question. And then you've got to move forward on this cumulative 12-month cycle. So just pause for a moment and see what you get from your calculator by adding up the 12 months from June 15 through to May 2016. So if you do that for me, please, and see what we get to. Now hopefully when you've added through those numbers, that figure has come to £64,400, again if I've done my arithmetic correctly there. So we haven't yet in that 12-month period exceeded the compulsory registration threshold of 82,000. So what do we then do? You move forward month by month. So we now add on the next month, June 16, and take away what was June 15. So in the 12 months to the end of June, what do we then get? So again, take your £64,400, add to it £11,800, and take away £3,900. Now if we do that, then that next total, well, you work that one through if you would. And hopefully the 12 months to the end of June, you now get equal to £72,300. Now that again is below the VAT registration threshold. So as at the end of June 16, you're still not required to register for VAT. So what do we now do? We move on to July. So add in this July take out the previous July. So we'll be adding £14,500 to our £72,300 figure and taking away the £3,800. Now if you put that one through your calculator, hopefully, you can pause this if you want to while you're doing that, but hopefully do check that then comes to £83,000 worth of sales. These would be, if we were registered for VAT standard rated, so they're taxable supplies here, but the VAT exclusive figure, because until we register for VAT there is no VAT, that figure now 83,000, 12 months to the end of July. Therefore we now must register for VAT. So when Orchid will become liable to compulsory VAT registration, that's from the end of July there where we've exceeded 83,000. It is at that point that VAT registration is required. When must we notify Hmrc? 30 days after the end of July, so that therefore will be the 30th of August 2016. 30 days on from the end of July, that's the 30th of August. The date then when Orchid Limited will be registered from in terms of VAT, well, the month after July would be August, so from the end of August, i.e. with effect from the 1st of September of 16, the business must and will be VAT registered. Meaning that we've then got to account for output VAT on our sales, and we can recover input VAT in relation to the purchases and expenses. That's a typical little exercise there that could be an objective testing question. It could be part of a written question, probably something in an objective testing question. But add up for 12 months. As you add up, check at each month at the end of 2nd, 3rd, 4th, 5th, etc. Have we yet exceeded 82,000? If not, once you get to the 13th month, add in that month and take away the earliest month from 13 months previous. So you keep going forward on a cumulative 12-month cycle. When that 12 months exceeds 82,000, then you're required to register for VAT. Now, by all means, at this point, again, just have a little check through with the answer and make sure that you are happy with said answer. Okay, well, we said that compulsory registration would be required in either of two circumstances. The first one, and the most usually tested, is the historical turnover basis, where, as we see, as soon as we get to the end of a month, at which month end we have exceeded the compulsory registration threshold of £82,000, then we are required to notify Hmrc within 30 days, and then will be registered with the start from the start of the following month. Now we look at the future turnover rule. A trader must also register for VAT if taxable supplies will exceed, again it's the same VAT registration limit figure of £82,000, but here during the following 30 days. Within the next 30 days we will exceed £82,000. Now this is regardless of any taxable supplies preceding the 30-day period. Again, that figure is exclusive of VAT. So if at any point in time we see that in the next 30 days our level of taxable supplies just purely in that period will exceed £82,000, we are then required to register for VAT. So again, we need to know when must we notify Hmrc and from what date will we be registered for VAT. Hmrc must be notified by the end of that 30-day period. The trader will then be registered, note now, from the beginning of that 30-day period. So it's not like with the historical registration where, if you recall, let's just go back and have a little look at our example there. If we hit the VAT registration limit at the end of April 16, we would not be registered until we had there with effect from the 1st of June 16. So you had the following 30 days, and it would be the beginning of the next month in which you would then have to account for VAT. Be registered from the 1st of June. Now look at what's happened on the future turnover rule. On that basis, we must notify by the end of the 30-day period in which we make those sales, and we will be registered from the beginning of the 30-day period. So yes, we will have to account for and charge output VAT on the sales that we make within that 30-day period. Little example 2. Tulip Limited commenced trading on the 1st of April 16, and we forecast income £90,000 per month, and the sales would all be standard rated. £90,000 per month. Therefore, we know from day one, from the 1st of April, that in the next 30 days, the VAT registration limit of £82,000 will be exceeded. Now, because that is the case, when must we register? Well, when must we notify, I should say, Hmrc? We must notify Hmrc by the end of that 30-day period. So we must notify by the 30th of April 16, and of course we'll be registered from the start of that period, the 1st of April. So all the sales made from day one of that business will have to have VAT charged upon them. We must register within the 30 days to the 30th of April, and will be registered with effect from the 1st of April. All the sales from day one will be within the VAT system. Equally, of course, all of our inputs, our costs, our purchases, our expenses, all of those, again, will be able to recover the input VAT in respect of. Okay, so go back over and revise through what we've done in this particular session and get to grips with these 2 compulsory registration rules in relation to VAT. That is the historical rule, historical turnover, and the future turnover base.